too hard for me. Okay, tonight, what we're going to talk about today is imagine that you can hit a baseball, perfect on every pitch.
Oh.
You can hit the basket shooting your basketball really well, almost every time. Now,
that never happens in trading.
No. But if you could, and you could hit the 3 points every time, you would want to do these strategies, because these are some of the best strategies if you are correct. Now, if you're not correct, these have a lot of risk. Okay?
Okay, so we're swinging for the fence then? Is that what you're telling me?
We're swinging for the fence, and where this comes into play. If we were going to do a naked short option, either one, either a call or a put, you got to hit it correctly. Okay?
Meaning if we're going to sell either one.
Either one.
Okay.
Okay?
Got it.
But in these, what you're doing is something that is very good because it does give you a range to swing for the fences, and it uses the same concept of time decay. So you're hoping that you're going to get out of this at some point with saving some profit. Your profit comes from selling. Okay?
Okay, if I could interrupt for just a second, you're talking about short strangles and straddles, not long strangles and straddles.
At this point.
Okay, got it. My brain was wired for long, but we can do short.
No. I think that you have either one is a viable strategy. The ones that are long, that are good for earnings, and the short have a good reason for earnings also.
Okay, as long as we focus on one at a time so we don't get everybody too confused.
Gotcha.
Including myself.
Okay.
Okay.
So, let's start from there. And here's what our unlimited risk, only level 4 could trade. That's true. Definitely not for beginners. That's why I said this is for the people that really hit for the fences, and so you want to focus mostly on the long straddles and strangles. Okay?
Okay, cool. That's good, because that's what I was ready to talk about first.
Good. Okay.
Okay.
The short straddles and strangles are high-risk cousins of the butterfly and the condor. So that's something we won't get into. Okay? Or not much. You know, the way I've heard it is, you know how they make those blowfish in Japan?
I've heard of those. Yeah, you have to get it exactly right or you just die.
Exactly. And that's what happens with the short straddles and strangles. The only other thing I'm going to say, the way to remember how it's called a straddle or a strangle. If you think of a straddle, okay, or a straddle, you're straddling a saddle, okay? You're going to ride your horse. What do you got on the front? This little tiny horn. You put one hand on that, okay? So you're going to have a single point where you're going to have the same long or short, depending on how you're doing it, the same long call and put together. That means you're going to get a lot of profit if you're right. Okay. Or a lot of loss if you're doing longs. What you're doing with the strangle is putting your two hands to strangle somebody, so you're going to have two different places, and that gives you less possible profit. But in the case of a short, but you're going to have much more of a range to be able to go. So, with that in mind, go ahead, Dilafng.
Okay. Well, the first question I want to go over is, why do we use these, and or when do we use these? Actually, both. The reason that you would want to use this, so let me back up. I'm always backing up to the previous weeks just to give people a little refresher. When we buy a call, we want the stock to go up, and when we buy a put, we want the stock to go down. Now, if we're pretty sure that a stock is going to move, but we don't know which direction it's going to go, then we might want to do a straddle or a strangle, in which case we're going to buy one of each. And as Joel said, for the straddle, we're going to pick an expiration, however far out, preferably after some news event, but I'll talk about that in a little bit. We're going to pick a date that's a bit out of the way, probably at least 3 or 4 weeks out, I think, just to make sure that we're not paying too much for our trade. And then we want to choose a strike that is at or at least near the money. So let's look at, we have a couple of options here. I asked before in the chat room, I told somebody, quick, give me a ticker with an earnings report coming out. This is earnings season, so this is a great kind of a trade to do with earnings season coming. And that's because when earnings come out, we tend to know, or we tend to expect anyway, that stocks are going to move. And that's what we're looking for here. If we're going to buy one call and we're going to buy one put, we don't care which direction it moves, because we're covered either way. If it skyrockets, our put that we purchased is going to go to 0 probably, but the call that we purchased is going to go up in value a lot. It'll go up enough to make up for whatever we lost on the put. Likewise, if we buy a put and a call and the stock goes down on earnings or on some other anticipated news event, if it tanks, then our put is going to be worth a lot of money, and the money that we make on that put, because the stock drops, is going to exceed whatever we paid for the call. So again, we're just looking for something to move, and since we're buying one put and one call, since we're going to be a purchaser of options, we want to get into this trade when the options are cheap. Now, when are the options cheap? They're cheap when the implied volatility is low, and they're cheap when the stock hasn't been moving very much. And we also know, as we've discussed before, that right before a news announcement, or maybe 1 or 2 weeks before a news announcement, or 1 or 2 weeks before an earnings announcement, we know that people start getting edgy, and they start wanting to buy insurance, and they start wanting to gamble on a big move. So as you get closer to that news event or that earnings announcement, the implied volatility of those options goes up, and people are willing to pay more for those options, so the price of those options goes up. So what we're looking for on a trade like this is we're looking for an underlying stock that we think is going to move a lot on a news event, but we want to know that news event 2 or 3 weeks out at least, so we're getting the option at a lower price. So Learjet and Kumar both gave me a couple of tickers. One of those was CTSH. Okay. So I haven't looked at any of these yet, but let's look at them and see if they fit our parameters for what we might want to look at, whether we're going to do a straddle or a strangle, and where we think the stock might go, or if we think it will move very much. Okay, now, let's see. Joel, can you pull the chart up first?
Sure. Let me go to...
Wow, look at that chart. Oh, my goodness. I hope nobody out there is holding CTSH, because, boy, it's gone down. I hope you're holding a put, people.
Let me do this. So
this thing has been just tanking. It's down near its 200-week moving average, and it looks like it's pretty oversold. The earnings date is about right. It's May 8th, it looks like, based on what I'm looking at here on my screen. So that's what, 2.5, 3 weeks away?
Yeah, let me do this. CTSH, and this is going to be our chart, and we're going to look at, instead of a 5-minute, we're going to go to daily, and we're going to go to, let's say, a year by the day. Okay, and this is about as ugly a chart as I've seen. My guess is, and here I'm going to do something here. I want to try something.
Okay.
So let's go here, and the 52-week implied volatility high was 45, almost 46%.
Okay.
The implied volatility low for the last year was 15.9%. The current implied volatility percent is 100%.
Oof, those are going to be some pricey straddles or strangles that we're looking at right there.
Right. Now, let's think. Besides it's coming up for earnings in 3 weeks, is that what the deal is?
2 or 3 weeks, yeah.
Okay. What else could be causing this huge volatility?
Well, the fact that the stock just fell out of bed is causing a lot of people to want to buy insurance. So that would explain why the puts are so expensive.
Right,
and of course the calls are going to go up too. They sort of work that way.
Well, think about, what is volatility called for the market?
What is it called?
It's not an ETF, but it's a
VIX. The VIX.
The VIX. Okay, and what is the VIX? Okay, no pressure. Huck says she does not have sound.
Uh-oh. Is she on channel 2?
Oh, that's the problem. Yeah, hold on, Huck.
It's going to be a little bit, I think, before people get used to looking on the other station.
I'll tell you what, I'm not sure about this, but okay.
We'll see.
Huck, we're on DTR2. Let's see if that helps. Yeah, this is difficult. Because people aren't used to that.
Yeah. We'll get used to it.
Yeah, we'll eventually. Okay. Yeah, try to help her, RPM, if you could. Okay. So if you think about what the VIX represents is volatility. When does the VIX go up? Huck, RPM, the volatility the VIX goes up, and it represents volatility when the market's dropping. Where that came from originally was the big boys who were buying the SPX, the 250 per dollar contract, okay? Not the E-mini, which is $50 per contract. Okay. They were buying puts, and that's really kind of what the VIX represented. Well, Here we're looking at something that's dropped pretty drastically for 1, 2, 3, 4, 5, 6, 7, 8 days, 8 trading days. Okay? Dropped from 75.50, it looks like ish. Okay? And right now it closed today at 61.93. So it's in this time it's dropped almost $14, 13 and a half bucks. So, because of that, the volatility's high. And what I wanted to show you here is on toss, let me go back, there is this today's option statistics. So it shows you, do I want to do that long straddle or strangle? Or do I even want to do a long option when I'm at 100% of the implied volatility high? Okay?
No.
And that's exactly right, Di. So go ahead. I just wanted to show that so people can start thinking, when do I want to do certain strategies? And toss is good with that.
Yeah. With toss, you can actually graph the implied volatility down at the bottom of the chart, so that's very helpful. So I look at that chart and immediately I go, no. Number one,
not this one.
Number one, it's already made a big move. The chances of it making another big move, it might, but it seems like after a big move like that, things might settle down for a little bit. So I'm not thinking that that's going to move a lot in a couple of weeks when earnings come out. I could be wrong, but let's look for something a little higher probability. Second of all, the IV, which is the implied volatility, is way too high, which is going to make that trade way too expensive. So again, I'd be moving on from that one. I was going through my list here, and I found one. The IV is a little bit high on it, but the chart looks a little more attractive for the possibility of a straddle or a strangle, and that is CenturyLink. Joel, the ticker is CTL.
Okay.
And this is not one of the ones that my dear friends Learjet and Kumar came up with for me.
Okay.
But the earnings date is right around May 8th, so it's a couple of weeks out.
Okay.
And the chart has had some small candles, so maybe this thing is going to move a lot. And once you pull the chart up...
Okay. And we want CTL.
Now, I got a question from Learjet about how high is too high for the IV. And I'm going to answer that the way I answer usually for that, and that is it's not a number. What you're looking for, and we've talked about this before, when you're just buying a call or just buying a put, you're looking for a low IV because that's going to mean that your price on the option is basically your option's on sale. If your IV is high, that means there's a big premium on that option, and it would be better to go find a different trade where you're not going to pay so much premium. Now, when you're looking at options, the IV, the range of IVs is going to be different for each stock. Some particular stocks might have an IV that ranges from 20 on the low side to 40 on the high side, and it just depends on how volatile that stock is and how volatile those options are. In the case of a stock with an IV of 0.2 to 0.4, then when you're looking to purchase options, I would say you want to see an IV that's in the lower half of that range. So you would not want to buy options when the IV for that particular stock, say over the last few months, or actually, you would not want to buy a stock for that. Let me back up. You would not want to buy an option for that stock if the IV was above, say, the middle of that range for the last few months.
Good.
So, if you look at Apple, the IV might be, let me look here real quick and see what the Apple IV did. On my screen, I'm looking at the IV for Apple over about the last year on the daily chart. Now, the high is about 0.45 and the low is about 0.27. So if I wanted to buy options on Apple, I would probably want the IV to be below about 30. That would just assure that I'm not paying too much for it. So again, just in the lower half of the range. And in TOS, you can go into your studies and you can add implied volatility at the lower part of your graph, and it'll show you the line. I don't know if you can do that, Joel.
What's that?
Can you go to the chart and add IV at the bottom of your chart?
Oh, I might be able to. Hold on.
So that was a long answer to a short question. How high is too high? Well, in the upper half of the range, I would say it's too high. You want to buy when the IV is in the lower half of whatever the range is for that particular underlying stock. Now, we were looking at CTL, and this one's not going to be perfect. If you look at the implied volatility on CTL, there you go. As soon as Joel gets it up here, that's that blue line at the bottom. That's showing you the implied volatility. So over the last few months, the implied volatility has been as low as about 0.12, it looks like, and about as high as 0.27. And right now, we're near the high. So I would not be doing this trade on this particular underlying stock right now, but
let me do this. I'm going to show something here real quick.
Okay.
Let's go to the calendar on TOS. Okay. Let's go to this week. Okay. Why am I not getting... I want a weekly. I want earnings. Come on. Oh, you know what? It works on my reel, but it doesn't work on I've got the reel over here. I don't feel like doing that, but it works. Let me find AVB Ben. I'm trying to see something. BP may be okay. Let's see how BP is.
Okay.
Okay. Let's go to BP.
Ooh, that one looks good. I like that.
I don't know why we're not getting the is it an ADR? That's why. That's why we don't have the what's called.
The earnings date?
No, it's not the earnings date. Earnings is April 30th. That's not a problem.
IX Equinix shares trading near the lows at the hours now, 189.12.
How are we getting that?
Down about 12% after an earnings miss and lowered guidance. Echo Quebec India X-ray 189.12, down from the close of $216.38.
I don't have it.
I don't have it either, I don't think, unless well, let me make sure I'm muted here. No, I don't think it's me.
No.
Huh.
It is muted.
It's the ghost of whomever.
Okay. Okay, let me make sure that everybody's muted here.
Yeah, I don't think I have it open.
I'm pretty sure I don't have it open.
Oh, maybe I did. Shame on me. I think it must have been...
Oh, my God. You're kidding. You have it open?
I'm fired. It was an
Oh.
I'm sorry. I'm sorry.
Oh, my God. Okay. We'll forgive you this time.
All right.
Only this time. Okay.
That happens. Okay, BP. BP is beautiful. Let's get back to BP.
Good. Let me, it is April 30th. Let me go to BP and I'll show everybody BP there. Okay, a nice one. A nice, flat, low volatility, as you can see, the bluish line, the cyan line at the bottom. Oh, yes, by the way, our buddy Learjet, at least it's Dilafng's buddy, not mine. I'm sorry, I shouldn't have said that.
I love Learjet. You be nice to him or I'll come after you. He's awesome. No, he put together this great study guide, and it's in the forum if you're in the chat room.
Yes, if you're in the main chat room, it's a great link.
Yeah.
And I do kind of sometimes I like Learjet.
Yeah, I know you do. He's hard not to like.
I know, but that's okay.
You did a great job, though, explaining everything. And, I thought about just coming on and reading that, because really it's all right there. And then
it's very good. Not all the time, though, Lear. But this is...
He's very well-spoken. It's very clear. He explains things
very well. He really does.
Very well. And he did another one in there that I want to point out, and maybe he could put the link in the room. He did another one on the Greeks, which again, very, very easy to understand, great for beginners, and definitely highly recommended reading.
Okay.
So those are, if you're struggling to take notes here, he's already done it for you. Just have a look at that.
Yes.
That
and very well. He really did. I mean, a great job on it, Lear. Thank you. So here we are, and again, if anybody has a real account with TOS, and again, what I say is, open an account with TOS and keep some money in it, and they'll let you have it forever. But it has if you go to Market Watch and you go to Calendar, this, instead of having nothing on it, shows you everything that's going to be for a particular week or a day, earnings-wise and dividend-wise, and conference calls and other events and so on. So I'm not going to take the time to bring up the reel here, but that would be there. Now, here, because BP is an ADR, or it really isn't an American or a U.S. stock, so because of that, that's the only reason I could come up with is we don't have the option statistics. But we do have options, and we have weekly options. So this really makes it very good. Go ahead, Di.
No, I agree. This is good. So the IV, as shown on the chart, is low. If you could go back to the chart, that would be great.
Mm-hmm.
The IV on the chart is super low, which is right where we want it, because we're purchasing a put and purchasing a call. Now, the other thing that I see when I look at this chart, which is good, is that there have been some gaps on this.
Mm-hmm.
So the suggestion there is, well, maybe this thing has some possibility of moving. I don't see huge gaps on previous earnings. Ideally, you want to see this thing, you want to see it to where it's moved a lot. Every time the earnings comes out, it moves 20 or 30 points. That's the kind of trade that I'm looking for. I want this thing to just skyrocket or tank one way or the other, because that's the way this trade's going to make money. So from that standpoint, I don't know that this is an ideal stock, but we can run the numbers anyway and just have a look and see how they come out.
Well, hold on. Let me see if there's anything else that is Bud. No, Bud's pretty lame.
Yeah, I don't know how much time, Joel, we want to spend looking for.
Yeah, go ahead. Go ahead. BP really is where it is. Okay.
Looking to see, if it does move, where is it going to end up?
Okay.
So let's assume for now that we're going to do not a strangle, which is different strikes, but let's assume we're going to do a straddle. So we're going to trade something far enough out time-wise that it's going to be after the news event. So let's say we want to go at least 3 weeks out. Let's look at the May, just the standard May options, the monthly.
Gotcha. Here
there
we are.
Go. And then we want to buy a strike that is at the money.
Okay. We have 62.64 cents on the call. in the money, the first in the money, which is at the money. The price of BP is $42.08. Boy, has that come up nicely and then drop. And the first out of the money was 22 or 23 cents. So which one do you want? That's the call.
Well, we're going to buy the same strike, put, and call, right?
So
go ahead.
I probably would buy the 42.
Okay.
Is that what you think?
Yeah, that's fine for me.
Okay, so I'm going to go in here and I'm going to say 42, I'm going to buy, and I'm going to say remember, if it's a straddle, I'm sitting in my saddle, so that's going to be the same price. So I'm going to pop up on here, I'm going to buy a straddle, and that's going to debit me $1.58, just roughly.
Right, that's about the mid price.
Yeah, that's how this does it, okay?
Okay. So you're paying about half of that price for the put and about half of it for the call. Now, let's go and look at the risk graph and see how much we need this stock to move in order to make any money on this trade.
Okay, now let me correct you a little bit.
Okay.
60 some cents of this is the call, and 90 some cents of it is the put.
Ah, you're right, I see that.
Okay.
Yep.
They're both at 50 deltas, so they're saying 50-50 chance this is going to be in the money, either one, okay? So it's about 40%, I'm going to say, is going to the call, and about 60% is going to the put. So
okay.
Somebody thinks the put's more valuable, okay?
Right.
Okay.
Yeah, somebody out there is willing to pay for some insurance in case this thing goes down, apparently.
Correct. So I'm going to go to the risk profile now.
Okay.
And here we are.
Thank you for the correction. Now, looking at this risk graph, as we will recall, the horizontal axis is the stock price, and the vertical axis is the profit and loss. The white line is showing what that trade is worth today, and the red line is showing what that trade is worth at expiration. So as we move toward expiration, that white line is going to start creeping down toward the red line until at expiration we are down at that red line. Now, on the profit and loss, the zero line there, that is where the trade is going to be break even. So our break even point is where that red line, our break even point at expiration, is where that red line crosses the zero line.
Okay, so that's 43.58 at the high.
Side. Okay.
And it is, and it's 43 on the downside.
40.43 on the low and 43.58 on the high.
Right.
Okay, so the next thing I would do then is I would go back to the chart and try to decide if I thought this was worthwhile. I want to at least break even. Ideally, I'm going to make some money. Now, we can tell by looking at the risk graph, that line is above the zero line on the profit and loss when you're either below that dot where Joel has his little pointing hand right now, and we make money, meaning that red line, the white line, is above the zero line if we are above the 43.58. So we need this stock to move at least to those numbers, or one of those numbers, in order to break even. We need it to move even farther away if we're going to make money. So let's look at those numbers on the chart and see if we think BP really is going to make a move like that. And that's how you can help decide whether you want to take this trade or not.
Okay.
So if we go back to the chart,
okay.
Now the low side is 40.43,
And that's got a lot of support at that price of 40. Do you see that, Di?
I do. There's very good support there, yeah. So if it went to 40, we'd make a little bit of money. Probably not a huge amount of money. We could go back to the risk graph and check that. You know, so it could go all the way down to 40 and maybe find some support there. But do we really think it's going to get to 40, 43? Is it going to make a gap that big on earnings? Based on looking at the graph, I'm not so sure that it will. It's not that volatile of a stock. It's an old, it's an old company. It's been around for a while. People trust it. It just doesn't jump around like another stock would, like an Apple.
Hello? Up. You okay? Di? Di? In the room, do you hear me? Type a 1 if you hear me. Okay, thanks, JDub. You there, Di? Hold on, I gotta get her back. Shoot. We're having problems here. Technical problems. It does sound like a smack, doesn't it? Internet connection problem, so it's her computer. JDub, you want to call in, buddy? Okay. No, Kumar, we're doing both. Di, you there? Okay. I'll keep talking here at this point. And then we'll wait for Di to get back. Yeah, her Commodore works great. Kumar, do you want to call in? No problem. Do you want to call in, Kumar? Yes, you do. You got plenty to say. Oh, J-Dub's calling. Okay, let's add the group. There we go. Hey, J-Dub, how you doing, buddy?
Good afternoon. How are you?
I'm doing fine. Now, you told me that you did a couple of trades.
Yeah, I was pointing out that that Apple trade from yesterday was a good candidate for a straddle. I didn't actually take that.
Okay, why do you say that though? Let's give it to some concept of why you would take a trade like that to to get into.
Well, typically, if you look at Apple's last 3 or 4 earnings reports, it had an average of a 20 to 30 point move on the open the next day.
Okay.
And if you had taken that straddle early enough, before the premiums had really exploded, it was still a worthwhile trade, in my opinion.
Correct. And this is the big thing. If you look here at what Jordan is JDub, by the way, guys. Here's where earnings are, and what happens to the implied volatility. Goes up. Here's where earnings are, and what happens to implied volatility. Goes up. Then what happens here at the next day is it drops through the bottom. Okay, so where this is good is if you do this with a short, it can work. And why? Well, you're going to short this or sell your strangles, straddles, and options at that point. We lost Di again, so hold on. Let me see if I can get her back. Anyway, so that's why you would keep doing buy perhaps here yesterday, or sell perhaps yesterday. And yeah, Di, it would be great if we could have you, because you were on a roll showing us. And here's what happens to your implied volatility. Now, when implied volatility goes, the price of your option drops too. So if we look at how a short situation would happen, every time right before you have your every time we have our earnings, we have a high volatility, and then right as soon as earnings end, we have a drop of volatility. What Jordan was saying was here, if you bought this on 327 and the earnings was 420 or 423, okay, so if you bought it 3-4 weeks before, okay, the implied volatility was 27%. Yesterday, it got up to 45%. So, if you bought it then at the low 27%, your price of your option would go up tremendously, even if the underlying stock didn't. Is that what you're saying, JDub?
Exactly. And actually, I wasn't even looking at it about 4 weeks before. I started to look at it around 2 weeks before, which you still would have done okay, but in this case with Apple, since it's the center stage, I guess 4 weeks would have been definitely more appropriate.
Yeah, and it's because Apple's such a volatile stock too. I mean,
right.
You're not going to get that same kind of swing perhaps on some other ones as you would here.
The other example I wanted you to bring up, if you didn't have another one, was CMG.
Okay, CMG.
Right, Chipotle.
Yeah. They
reported last week on the 18th.
Okay.
And they had a crazy spike.
CMG, so that's chimichanga or Chipotle.
Right.
Okay, now, notice again, here's our earnings on that day of right before earnings. It got up to 57%. And the next day, it dropped all the way to 37, and 2 days later, or 4 days later, it was down to 32. Here, you know, the 18th, I guess, when did it have earnings? I don't know offhand, JDub.
I believe it was the 18th. 15th,
Yes, okay, that is the day. It was up to 46 per, you know, for implied
REGN,
volatility.
Regeneron Pharmaceuticals, now at 217.25 after announced that it will replace Metro
Okay,
PCS
I'll
and the
have to
S&P
find
500.
where that
Had
is,
been
'cause
rumored
I
to
don't
be
have it.
HCA Holdings, but it's
Okay.
Regeneron Pharmaceuticals.
And then it dropped all the way from 46 on the 18th till today. It's down at 25, 26-ish. So, you know, that covers an awful lot of movement. So this would be something, but if you bought it, let's say at the 1st of April, it was 36% and went all the way up to 46%. That's going to cover a lot. Okay, go ahead. Tell me what you would have done if you had done it early.
Well, I did like it long, but I was not willing to just take a plain old call. I would have bought in at the money or near the money, put and call.
Okay, so we would go right back to our Analyze tab, go to the Simulated Trade on Chimichanga, CMG, and there we go. Okay, so you would have bought which one? The May?
Right.
Okay, and that was, now this is, I hate to go to think back. Well, let's do that. Let's go
we
to
can do
think
that.
back.
We can do that briefly, and then we could. It's nice to look back in 2020 hindsight, but Learjet asked about APA, so maybe we can go to Apache next because that's an upcoming thing where everyone could actually make some money.
Perfect. Let's do that. APA. There we go. That's Apache, guys. And Apache's a mover. And we have 23 days until... Why are we not getting... Maybe it's because it's at the end of the day, or... Let me see if... Let me go to... on the real one, APA, is it just that this closes off today's option? No, it's, if I'll have to do this next time on real, because it doesn't show up as on my paper account. Right now, APA, Apache Corporation, has a high 52-week implied volatility of 44 and a low of 21.5. The current implied volatility is 25. So, you know, we're in the lower area of the implied volatility. We're in about the first quarter quadrant. Okay? Now,
Right.
You can't see it on ours because I'm on the paper account, and if we took a break, I could turn it. You don't want to do Coinstar. Oh, okay. I see what you're doing. Tomorrow, you were asking. So here, we could do, let's say... Let's take a look at the chart for Apache and see what we like in direction-wise. Personally, directionally, this could still go down. Is that what you would say, JDub, looking at what I've got?
Certainly.
Okay. I mean, I just want to get your feeling. Earnings is, see, this is another thing. Earnings is 5.9 before market. So we got, 2-3 weeks approximately in that range. So here we are, and it looks like, according to my stochastics, we could turn back down fairly easily. We're in kind of a down area starting from up here where it hit the 200 line. That's my red dashed line. That's the 200 EMA. And it hit the 45, traveled along that, and then dropped even faster. So, if we look at this, I would say this has a good chance of going down. But if we could look at something, I probably would say, what? We're at the bottom of the range for a year. We got a good way to go until the high, 81. And right now, we're at about 60, 70. We're about 71.34. So let's go back to our analyze and say that we want to do.
So you're searching for strikes now, yeah?
Yes.
Okay.
Which would you choose? I just want to ask you. Do you have an opinion or not?
Let's put that out to the room.
Yes, good idea. Let's go to the room. We have $2.50 spread. So everybody saw the chart. We could go in the money on the call side at a 70. Right now it's 71.34. It went up 88 cents today. Or we could go in the money on the put side, and that's 72.50. Which one would the room like to try?
Why don't we run them both? Run the first
Sounds
scenario.
good. That's what my next one was. Okay, here's what we're going to do. We're going to buy a straddle or strangle. Which one do we want to do? A straddle, right?
Right.
Okay. So we're going to do that, and then we're also going to buy the other straddle. Okay? This is what's nice about this Analyze program. And I'm going to take off one. We're going to try the one first. Okay? This one is going to cost us $4.02. We are buying the 5.7. So I don't want it that far out. Hold on, I'm just adjusting a couple things. Okay, so there's 4.30. That's next week. Okay? Next week, if it goes either above 72.66, okay, or below 67, okay, we can start making money. My guess is we gotta hope, remember, let's go to our chart. Here's 67. That's, unless it continues on down, and it could. 75 is where this resistance is, and so far we're at the low of 67 is the low, period, for quite a while.
Some of these can get tricky, particularly stocks that are tied to commodities like oil.
Yes.
Apache is a natural oil and gas driller, so it can't, if the commodity that it's associated with starts tanking or spiking, sometimes that affects it as well.
Correct, and I do agree with that completely. But we are hoping that it has a big move.
Right.
Okay? So, because we're hoping for a big move, we're saying that it could be, we have resistance up here at about 76-ish. Okay, I'd call it 76.50 maybe. And we're at the low we hit was 67.91, so 68. So we got to break 68 to the bottom or 76, 77 to the high. Do we have any trade on that? And we'll go back to our risk profile. Well, 67 is where it starts making money to the downside. So we better hope that Jordan and I were right, that this looks like it could go down. And another up is 72. Now, because resistance was up at 76, 77-ish, and it's only got to break 72, we got a decent shot for the upside. Okay? If you look at this lighter area here, that is one standard deviation. In other words, a 68% chance that it's going to stay inside of this. But we still have a decent run to the outside. So that's where we were doing the 70 call and put. We were buying those. Okay? So let's take this one off and put the other one on. And what happened there? We went to the upside and said, oh, wait a second. Now our break-evens are going to be for the 30th. Okay, a week, almost a little less than a week from today. We're going to have 68, 69, I'm going to call it 70. To the downside, if it goes below 70, we can start making money. To the upside, though, where before we were down there in 72, 73 area, now we got to get above 75 to the upside. So,
actually, who's your daddy likes the APA on the daily as a long here? Because I assume you're thinking that it's at support, so there's a good risk reward there.
Now, let's look at it again. We don't have support here. What we have is the low of the low. Okay? Now let me go out here and see if on 2 years. No, we've never been this low on Apache. This is the low for 2 years also. So there really isn't support here. I mean, as in there's 2 or 3 places where you can draw a firm line and say, oh, that's just work. And even if we go with drawing and say, a trend line, you can't do it from here because it broke that one. At best,
unless you're going back on a 5-year chart, but we don't want to start.
Yeah, I'm not going to go just to find a line.
Right.
So, I don't call it. don't get me wrong. I'm not saying it's wrong that this won't go up from here. Oh, for a short, swing trade, I probably say it's a good one. Who's your daddy?
Hey, Joel, let's try to move along a little faster. Learjet had asked to, in the same scenario, to change it to 65 and 75 strikes.
Ah, so let's go to a, okay, so we're going to go to Analyze. We're going to go to Simulated. Lear, which ones do you like? You want to go to a 65
and 75.
So let's go buy a strangle. Okay. So
and once again, the strangle, if they didn't explain it already, is with the theory that, and the hope that it's going to stay within that range. In this case, 65 to 75.
okay. Now,
Right
yeah.
there. Okay, no, you wanted a long strangle. Okay,
Yeah, let me flip this around a little bit.
correct. Sorry, Kumar, we did jump to the strangle, but we'll get back to the straddle. I know you asked for Whole Foods. We'll get to that.
That's still the same. That's just not what you'd want. Hold on. This is what it's going to be. Now, this is too far out, I think. Not interested in Whole Food or any other stocks. Let's try the call 65 and 75. Now that's going to be too wide a market. Let's try 67.50, and because I do think it could go to that, and this one could be 72.50. Now that's going to cost you $7. That's the problem. That's a very expensive one. Now let me bring something up real quick here. What we're doing here is we shrunk the wings. If this was a really volatile stock like a Google, it would be great because Google's going to move that much. Here, let's put this back to the call being a 65 and the put being a 75.
Are you trying to say there's not enough beta in the stock to make you interested? Yeah.
Yeah. I mean, there just isn't. Because you really got to get some swing in this thing to get that kind of profit.
Right, and that's okay. That's what we're here to identify.
Exactly. Now, I could go backwards on this and do, let me see something here. Hold on. Right now, I've got 65. Let's move this to 75 and 65. Now, if I do that, I have almost no, that cost me 93 cents if I put in the call. But see, that's not going to hit. Well, it could. Actually, that's a much better strangle. I did a 75 call and a 65 put, which are out of the money more, but they're showing up as decent because 73 is where it breaks next week. If it goes above 73 next week or below 67, it starts making money next week. And let me even go... Yeah, actually, that's not bad. It cost you 93 cents. You could buy a few of those and just pick up 20 cents, perhaps. 20 cents is going to come in. If you go to 75 bucks, you're going to make $70 on this. Now, you're only putting up $93. So if it gets to 75 next week, you could pick that up. And if it gets to 67 to 65, you would do the same. So, you know, is it going to go outside of 65 and above 75? That's where you're going to pick up a decent trade if it goes next week. Does that make sense to everybody?
So in real dollar terms, the risk profile, how much is he risking?
I'm risking $93 cents, $93. Okay.
It's not bad.
No, that one I could live with, actually. Okay.
Okay.
I'm not saying anybody does these. Okay.
Right.
Please.
Option trading involves risk and should only be used with risk capital.
Right.
So if anyone doesn't have any other questions on APA, we can move on to Dialer's choice, which was FedEx.
Okay.
And
so, let's go to the chart first, because you always want to know what kind of direction you want to think about. So we're going to go to FedEx, FDX. Okay, and here's another one that is in... Why are we picking ones? I mean, here we have... It's too far out. Yeah, it already did it. FedEx had its earnings on 3/20, so its next earnings is 6/19. Too far out. Way too far out. So what's another one?
Well, hold on. She said if you look at the July chain.
Yeah, but well, okay. Let's try that. So
Take a argument.
Right now, FedEx is at closed at 94.5 almost. Okay. So let's do something just real goofy.
Oh, I actually reread what she said. She said July might be too far out after all.
It probably is, but let's look at... Okay, first of all, let me do FDX. Oh, see, now I don't even have on my other FDX. They may cut off that thing at a certain time. FDX. Today's option statistics. Yeah, they may cut that off at after the close. Okay, now here, FDX. Implied volatility high is 38. Implied volatility low is 18. The current implied volatility is 22. So that's at about 22.5% of the whole range. Okay? So that's low volatility when you're in that part. Okay? So we're going to pull this down. We're going to go to I could even live with a June and see what happens.
Okay, let's run that one quick, and then we'll take maybe Dish Network, and if anyone has anything else.
Okay, we're going to do... Tell you what I'm going to do. We'll try, this one is buy a straddle in the money. And then I'm going to do, let's say this, buy a strangle. And we're going to get the put down at, try 90. See what that does. Okay, let's go in. So I'll tell you what I did in just a second. Okay, here's our straddle. Wow, that's odd. I might need to go up on the straddle to 95s. Yeah, okay. That looks a little better. And I'm going to go on this to June 5th. In fact, let's go to May 15th. Okay. Ooh, that's pretty ugly. Okay, they're saying FedEx. If I do this FedEx and I did the straddle and I did a 95 straddle. Right now the price is 94.46 is where it closed. Okay.
95 call?
A 95 call and a 95 put.
Correct.
So I'm doing a straddle at 95. Call and put.
Right.
Okay. That cost me $6.70, so $670. And it doesn't make money on the 15th of May. So about 3 weeks from now. It would start making money if it drops to 90 or below, or it goes up to 99.60 or above. Now, at expiration, its break-even wings are 88.31 and 101.70.
So the mechanics of that are that you're paying, you said $6.75, so the stock has to move up or down $6.75 to cover that premium cost.
Yes.
Just stating it for the members that might not be as familiar with the strategy.
Correct. So, if we look at it, if we put up $670 and we say, hey, 3 weeks, I'd be happy to, put up $670. I'd be happy to make $100, $120. Okay?
Which is a decent percentage return on $670.
Right. Exactly how I think about it. I'm not looking to extend this for life. Okay? Or even until it closed. But if I had to say, where would it make my In 3 weeks. I moved this. So the white line, instead of being today, is showing what would happen if it was the 15th of May. Okay? So about 3 weeks from today. At that point, in order for me to make about $100, it would have to go up past 101.50. Actually, 101.36. Not sure if T4P can call me or not. Yeah, I could.
Yeah, can you Skype her back?
Sure, hold on. And then let me just go real quick here. Below 88.37 is the other way. So if it drops below 88.5 or above 101.50 in 3 weeks, okay, I'm going to pick up about $100 either way.
And for each point that it moves above or below that level, Joel?
Yes, I make more. Okay, so let's say that it went all the way to 104 in 3 weeks. Now, that's a heck of a move for FedEx, okay? But it could, okay? I would pick up $300. That's not bad on a $670 trade.
Right.
This is mostly to do with getting in, getting your percentage, and getting out. These are, the long ones are, you have to do much in advance. Where do I leave group call? I want to call her.
You have to add the group call.
Yeah, but I don't see that.
Hello?
Yeah, you there? JDub, you there? Hold on, let me make sure Jordan's...
Looks like he's on hold now, see?
Okay, hold on. JDub? Shoot.
Well, you keep talking to him, that's fine. You can call me if you want when he's finished.
Okay, go ahead.
You got it, JDub?
Yep, is she there? Everyone's here? Okay.
Di, you there?
I am.
Okay, we got it. Oh my God, this stuff is so good. Someday I am gonna be good at this stuff. Okay, so what do you think, Di? I mean, you see what we're doing.
Yes?
What do you like, dislike about what we've done?
Oh, I don't like or dislike anything about what you've done. I just see, like Kumar asking in the room, okay, so, boil it down. What are we looking at here? When do we do this? So I'm happy to boil it down if you guys were done talking about a particular trade.
What do you
Bring it home, guys. Bring it home.
Yes.
I don't know if I can bring it home, but just to...
Di, there's no pressure, but you have to be perfect.
Okay, I'm going to try. I'm going to try to be perfect. My father brought me up to always try to be perfect, so I'm wired. I'm wired to try to be perfect. So you get that no matter what. That's just part of the package.
Okay, babe. Go.
Okay. So straddles and strangles, they're the same trade with the exception that with the straddle, you're buying the same strike, call, and put. And with the strangle, you're buying different strike, calls, and puts. If you do a straddle, it's going to cost you a little more, but your probability is going to go up. And Joel, correct me if I'm wrong. On the strangle, you're going to pay a little bit less to get into the trade, but your probability is going to go down because you need it to move farther from where it is when you buy your trade, your straddle or your strangle.
On your strangle, you're saying.
On your strangle. Thank you for clarifying. See, I'm all discombobulated now because I don't know, I think I was on a roll and then all of a sudden I was talking to myself.
Yeah, you were doing great.
Okay, so we're looking for something that's going to move. We want to make sure that we enter this trade when the price is going to be low. The price is going to be low 3 or 4 weeks ahead of a news event. It doesn't have to be earnings. It could be any news event that you know is coming. It could be an Apple conference call. It could be an FDA decision on a drug, approval for the drug company.
Now, those happen to be very good for that, actually.
Yeah, if you know that there's something big coming up, that's when you want to get in this. And you want to get in this, like I said, when the trade is going to be cheaper. And the trade is going to be cheaper a few weeks ahead of whatever that news event is. Because as you get to the news event, the implied volatility is going to go up, and your options are going to cost you more. Now, I think that folks have seen, or hopefully they've seen, by this exercise that we've gone through of looking for trades, these are not always easy to find. We talk about these trades, and you'll go to a class sometimes, and they'll show you the perfect chart, and they'll show you, oh, this is how this trade would have turned out. What they don't tell you is that finding these trades is the hard part. Not only do you have to find a stock with a news event that's coming out, but you have to find one where you think that news event is going to move the stock. Doesn't matter if there's an earning event. If the stock never moves on earnings, then move on. You need to find a stock where the IV is low so that you're not paying too much to get into a trade. If you think like that first chart we looked at, CTSH or whichever one it was, earnings might be coming out, but the IV might be super high, or it might have just had a huge move already. Okay, that's not going to work. Let's move on. So you're looking for a stock where maybe things have been a little bit sideways or a little bit steady. Maybe the stock is in a squeeze. It hasn't been moving much. Earnings are 3 weeks out. The implied volatility is low. And historically, the stock has moved, several points or several percentage points on earnings. Then, after you've found a stock that fits all that description, all of those criteria are met, then you have to go and look at your risk chart like you have right now. And you have to decide then, okay, how much am I willing to pay for this trade? Where are my break-evens? Then you look at the break-evens, you go back to the chart, and then you have to evaluate, okay, do I really think this thing is going to move that much or not? Because I'll tell you, the options market, if you will, they know how to price these options. They've got a lot of this stuff priced in. You might find a stock like Apple or Netflix or one of the ones that JDub mentioned in the room earlier, where they have huge gaps on earnings. But you know what? The market knows they have huge gaps on earnings. So even 3 weeks out or even 4 weeks out, you still might find that that stuff is so priced in already that you would need a $60 move to break even. So are you willing to pay that much to get in if that's the kind of move you need or not? Again, you have to make that evaluation. So finding these trades is definitely the challenge. And then we didn't really talk about exits, but you're getting into this trade for the sole purpose of watching it move on a news event. So if you get to the news event and the stock doesn't move, get out. If you get to the news event and the stock does move, get out. You have gotten to where you're going to exit this trade. You bought into the trade specifically because you wanted to move on this event. Once the event's over, the trade is over. I don't care what it's doing, get out. Don't hold on to it thinking, oh, maybe I'll get some more out of it. No, just close it. If you got the huge move that you were expecting, hey man, take the money and run, because you know what can happen? Let's look at Apple. Apple had a huge move, and all of this happened after the market. You might get that huge move and think, oh, hey, this is great. I'm making some fabulous money here. I'm just going to hold on and make some more. Well, sometimes those things revert right back to where they were. So as soon as you get your news event, whether you've made money or not, close the trade. And to close the trade, you would, of course, just sell the call and sell the put and wash your hands and move on. Now, that was quite a mouthful, and I'm sure I left something out, but I think I covered a lot there. Does anybody have any questions? Everyone's speechless.
No, I'm just seeing if there's any in the room.
I was going to say, can you still hear me?
Yes, yes. Yeah, a lot of times these are good, the long ones. Okay? The long straddle and strangle are good for, Kumar was saying it, for things like spy calls, spy and
on a Fed day.
Yeah, on a Fed day or something like that. Now, let me go back real quick. And this is my thing for the long straddle. Okay? So here you want it to move a lot. Yes, this is a naked straddle. Okay? So we bought a call, and we bought at the same strike price a put. And the way to remember that it's the straddle is on the front of your saddle, you know, there's that horn, and you just use one hand to hold the horn. Okay? Do I sell before the news? Yes, I do. I use this often, not for the news event, if I can pick up a percentage that I want to do.
Right. If there's a little run-up or sell-off before the news event, then he can capture that. He'll take it off.
Right. Because sometimes, you know, what happens is by the news event, you lose not just the directional momentum and movement, but you also lose price because of the volatility escaping. Kind of like letting the air out of a balloon, you know, that price deflates. Now,
that's a great point. You do take a risk when you hold through that news event. Thank you.
Yes, I generally don't hold it till the news event. I generally look for a percentage I'm happy with. Now, if I'm going out 3 weeks and I can even make 10% on a consistent basis in my trades, I'm thrilled. I just made probably 150% for the year with compound interest. Now, do I really expect that? Not really. I'm not that good. You know, I wish I was. Okay? One of the other things I want to show you is if you have a stock that is just stuck, doesn't move, but it's got some decent volatility for some reason. If you do this opposite, right now we're buying the straddle. Okay? If I go to sell the straddle, look what happens. I just flip this upside down, and if it stays at 95, okay, you know, I can make, if it's at 95, 94 or whatever, I can make $130 by the end of 3 weeks. If I hold this until expiration, I would get, in other words, it would be worth, I get $670 the day I sell it. Now, I just need to get rid of this at some day where I make my profit. That's the way you do the short straddles. Very, 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 very dangerous. This is where you can hit the basketball from a three-point shot 80% of the time. If you're not that good, watch it with these, okay? You know, and past performance does not guarantee a damn thing about the future. So, if I look, I'm going to take this one off. I'm going to go to the straddle, or strangle, I'm sorry. This one is going to be a little less, and I'm going to sell it instead. Now, look at what I've done here. I don't get as much money, okay? If it gets all the way up, I only get, when I sell this, I get $367 for each contract I sell. Okay? The way I did it. But at expiration, if I stay between $89, $90 really, and $97.50, I get all my money to keep. Even I don't lose money until at expiration now. So I'm not going to say you keep it to expiration. But at 101 and 86. Again, this is a dangerous strategy. But a lot of professionals do use this. Now, if you don't want to have the pure danger of something like this, there's another trade that Dilafng did an awesome job on describing in our forum. What's it called, Di, when you put in buys at a lower place?
Buys at a lower place.
So in other words, I sold the 97 call, 97.50, and the 90 put. Let's say that I bought...
You're talking about my iron chicken?
Yep, that's
Right.
called the condor, or...
The chicken condor.
Chicken condor.
Yeah, the way
sounds-
I do them pretty darn far out of the money. That's why I call them the iron chicken. But yeah, the iron condor, right?
Right,
guys,
and
guys,
what... Go
Can we
ahead.
back up for a second because Big Jim is asking about condor, so he may have missed that. Can you give a quick explanation of the condor?
Okay,
Condors or iron condors? There's two different ones.
yeah, do an iron... Well, let's do just a condor. Jim, do you know it? Or
We've been on an hour and a half, so I don't know if we want to go into another strategy.
Oh, no, I don't want to at all.
Okay.
I was just saying, if you want to take the risk out of it, you buy a further out contract
Right.
to be able... Good. Di's thing on that iron chicken is awesome.
That's also posted in the forum. There's a written post on it, and then there's a recording that we did with a couple of other traders. Learjet, I think, was Learjet on that one? I know Stock Bandit was.
I think Learjet...
It was a round table. There's a options round table. So the iron chicken is discussed, I think, toward the end of that recording, if anyone's interested.
Yes, and this will be in our forum hopefully tomorrow. Guys, it's Big Jim. It's French cuisine. I mean, you're talking, just the edge of food. Delish. Anyway,
Can we try one more example? Perhaps Dish Network, which is coming up.
Okay, real quick, we're going to go back to, and again, this is toss, Do I trade? I trade my options through toss, and I trade through toss, stocks and ETFs. So let's go over here. Let's go Dish. Dish is going to, we're going to go over here. We're going to put Dish in. Notice what I do when I want to see what do I think are real price levels I should be looking at. Here is my high. That was 110, 109 something. Okay. I had a ledge up here that was also current, so that was at 98. And then here was support at 90. So that's how I decide where do I really think I want to be able to put my prices, my strikes in. Okay, so let's go here to, again, to Dish. And this is not a big mover. This has been keeping real strong along the bottom at the 200. That's the red line. And it's been keeping very strong here. It just broke up above 38 something. If I look right now, this looks like it could still be up. My implied volatility is high. This is something, let's see, when does this?
May 6th.
I was going to say it looks like earnings on May 6th. It's got a question mark, but that's pretty close. So we have about 2-ish sort of weeks. Okay? We're already up pretty high on volatility, though. So this might be where I would actually want to short something, but we're going to go the opposite. We think that it could break above the 40. And, oh, they have a bid in on Sprint. Oh, that's why. I was wondering, why is this going up so nicely? But, you know, 34 seems to be about my, you know, my support, and up above 40 is my resistance. But that's pretty, you know, I could cut it back to about 34 and maybe 37, 38. So let's go and look at what we've got. Okay. We were going May 6th, is that right?
Right.
Okay, so we could do a May. So I like the upside to it, so let's do this. Let's do a straddle at my... Let's do both. I'm going to do a straddle at both of these so we could see. And then I'm going to do a strangle Okay, let's see how that does. Okay, so let's go over, let's take everybody off for just a second. Okay, so here's... so this won't work on the 6th. So let's go to... the 1st of May. Okay, there we go. Okay, so here we are, and let me even get a little further. There. Okay. So, where did we say that our support and resistance was? Well, we said it could go above 40. It's where it's at now. 38 was also kind of a resistance from before. And it looks like 34 is kind of the support area. So let's see what we ran into here. Okay. This does not make money at 40. It doesn't make money until 41.70. And it doesn't make money till 36. And what were our prices? I forgot.
Well, yesterday it was printing in the 40s. Today it had a problem.
Yes. Okay. So, is this one that we want to try? Let's go back to our chart, and I'm going to write this down this time because it's late. And as old as I am, let's look at 40, 34 was the high, but about 38.50 and about 34 something. Okay. 5-6 before the market. Right. So, I mean, I would not hold it that long, Jim. Let's go back, though. Okay. So now, if it breaks to the 34 that was the low, okay, we could pick up $160 or $170. With this one, we would be losing if it only goes up to the 40.34. Okay? So this one is not good. So I'm going to take that straddle off and try the straddle that's $40. Here we're even worse. We're at 42.78. But it does start going up nicely at 37. So let me try something here. Let's try 38. See, this is not a good straddle. Do you agree, guys?
I do agree. There are better candidates out there. And also, if this dish does make the bid for Sprint, if they're paying up a lot of money and the deal is not accretive, there's a better chance that this will fall to the downside rather than the upside, as the acquiring company usually moves down in a merger and acquisition.
Yes. So what we might have done is looked at Sprint, okay, because if we would have thought about that, I wouldn't now because it's probably already got a bunch of money in it. But let's take this one off and look and see what happens. Now, see, this is no way it's going to happen. Here is where I would do, okay, this is selling the thing. But again, I mean, this is just not a good candidate in my opinion.
Okay.
Okay,
Yes.
Di?
Yeah, I was just going to say, it's hard to find good candidates. You know, I did not spend the day looking for one. Maybe I should have to get ready for this call, but... Oh,
there goes Di again. Okay.
But I can follow up with what she was just saying and what she was saying previously, I totally agree that you have to do a lot of homework for these types of strategies and a lot of scanning to find the right strategy. Most of these candidates will not be lining up with all the criteria that you want.
No.
Is she back?
Di, you back?
I am.
Good. Good.
I don't know where I was cut off. Who's your daddy? No, I don't have any good ones. Maybe we should have done this call 3 weeks ago before the earnings started all coming out. But, all of those things have to line up. And so these are not easy to find. The low IV and the news coming and the chart looking right and, expecting it to move enough and all of these things. So, finding the trade is the hard part.
I'll tell you what, guys, because this is going to be recorded, okay, let me do something else here. Hold on. Hold on. I got to go talk to Nance for a second. Can you guys carry on for a second?
I think so.
Okay.
Now, Kumar's saying in the room, or no, JDub said in the room. JDub's, he's here online and he's in the room. He's spreading himself around. That's good. We were talking about, or he was talking about SPY. Now, I've never done a straddle or a strangle on SPY, but that's something that I don't know how much it normally moves. After the Fed announcement or the FOMC meeting, but that's the kind of thing, seems to me like it would normally be priced in. I don't know. What do you think?
That's a good point, actually, because these option market makers are not trying to give away their money, so they do usually price these things in.
Yeah, exactly. And that's, as I mentioned earlier, I think that's one of the other challenges. They do price this stuff in. So, the option prices, I know in Thinkorswim you can go in there and it will tell you, based on the option pricing, how much the market makers are thinking that a stock will move on earnings. I'm looking at Dish right now and it's telling me they have a plus or minus $1.95 on the expected move for the coming earnings. So that's telling you what the market expects as far as how much this thing's going to move. So you have to look at that number and then gauge, how much do you want to spend to find out if the thing is going to move more than that. So the option price is already going to have that amount priced in. Do you think it's going to move more than that or not? So, again, figure out what you're going to end up paying for this thing. Look at the risk graph, and then go back and look at the chart for your 2 break-even points and see if you think the stock is really going to move that far or not. I know a couple of days ago we were looking in the options room, we were talking about Apple. And I looked at all of the options, I looked at doing iron condors and put spreads, call spreads, long calls, long puts, and there was nothing there that to me was an attractive trade because the option prices were so high that nothing looked like it had a good enough risk reward for me to actually get in. Now I know RJ actually did buy a call and he made some great money on that, but that's a personal decision that everybody has to make. What are you willing to pay for this thing and how much do you think it's going to move? Is Joel back? I see that.
Yes.
Okay.
Yeah, I had to talk to Nance for a second. Now, here's a thing, and again, this is really not when it's going to, this is not going to expire then. I mean, you could keep it till then, but this red line is really, let me go up. That's, here, I got to make it that day. This is shorting the straddle, okay, and you get your money, you get 77s, or no, I'm sorry, you get $3.30, And actually, that's another way. Again, very, very risky, but it is a strategy. That's all I'm going to say. We could do this one. You see, it's got to drop by May 6th. It's got to drop below $36 or go above 41 at that point. Or you could do this if you really think, this is a 38.38 instead of the other one was 39 straddle. This one, you're thinking that it's not going to go up as high and you want to prevent your low. If we put them both together, we kind of get the concept, and that's how you work with these by adding new contracts in, and you can spread your risk out better. One of these days we'll go into how to repair option strategies. I say straddles are very, very difficult to do. I don't even like butterflies. Personally, I like Huck, have a great one. We might call you tonight if you're going to be home. But we're gonna kind of end it here, I think. What do you think, guys?
I think so. Yeah, I want to say, my mind was still on long straddles, not short straddles when I
agree. I'm just
on my latest. No, on my latest rant. So I just want to clarify that. If I didn't speak to your question before you went off to talk to Nancy, because I wasn't listening properly and I was talking about longs instead of shorts. So that's all I have to say. Thanks for listening, everyone.
Okay. Guys, what do you think? Think we've covered what you want? This is going to be in the room, in the forum. I'll try to get it up tomorrow, and you have more energy. Okay. I know what you're saying, Huck. Tell you and Steve good night.
Who's Your Daddy had one question in here about whether the, let's see, if the high yield affects the option price, or whether that's priced in.
What do you mean the high yield?
I assume he's talking about the dividends. Does Dish have high dividends?
Jeez, I'm you got to understand, I'm not a big yes on Dish, no.
Yeah, dividends are not something I really pay much attention to because of the strategies that I usually use to trade. For the strategies that I do, it doesn't really make much difference. So that would be a question that I would not even be comfortable answering, to be honest.
Yeah, I'm not comfortable either on Dish. Let me see if they do tell you.
9.3% yield, Who's Your Daddy said. That's pretty high.
That's very high.
Yeah, I would look into that.
That would make trouble with your options.
I would think it would, yeah.
That could cause some trouble with your options. Okay.
So I think that was the only question left that we hadn't answered.
Okay. Tell you what, Di, I'll put on some music.
Okay.
And
thank you
love
everyone.
you.
Thanks to everyone for listening. Love you too, Joel. You're awesome. Thanks for giving your time to the members like this.